Hey traders, Raghee here, and in this recap video we're going to dive into a little bit of the current macro environment, what macro means, and what it is that happened in the last day or so between some of Meester's comments and the FOMC minutes. Has anything changed? And really, I think one of the bigger conversations to have here is, are you looking at macroeconomics properly, or are you looking at fundamentals, headline psychology, and geopolitics, and confusing that with a macroeconomic stage, as I would say 98% of the folks on Chucklehead Media and most rookies and noobs tend to do. And it's really going to be a problem unless you know to differentiate these. So let's get right to it, because I really want to make sure you're keying in on the right stuff. Okay, so this is something I call the ABCD cycle. If you talk to most global investment managers, and the reason, I mean, who talks to a global investment manager? One of my mentors when I was a young girl for trading was someone who traded with a global investment background, and they're very macro oriented, global macro, as am I. It made my transition to Forex in the early 2000s, 99, 2000, really easy, because I was already thinking in this ABCD cycle. And you're going to see a lot of different money managers have this kind of cyclical or ABCD, cycle stages, however you want to look at it. A lot of folks are going to break it down to this, and most of us look at the same thing. What is macroeconomics, by the way? It is understanding the large scale or general economic factors, and specifically it is a rate of change assessment of the interest rate, growth, inflation, productivity. I mean, there's so many different factors, but here's the thing. It's a ROC. It's a rate of change assessment. We ROC the macro, meaning I'm gauging what CPI might be doing, GDP might be doing, what are the current monetary policy, what are the moves the central bank is making in any part of the world. Okay, it's not, well, we're getting along with China right now. That's not macroeconomics, gang. Meester commenting on what they might want to do to reinvest and keep a bigger balance sheet. That's really not macro yet either, but if they actually do something where they're going to reinvest and keep a larger balance sheet, that could then become a macroeconomic factor, because it's going to affect dollar liquidity, and that's a part of monetary policy. So a lot of interesting things in terms of what we want to measure. So what are you measuring, number one? What I measure, and you need to know that if someone says macro analysis, ask them, what is your rate of change? What is your process? What are you measuring? Most of the time they're going to rattle off headlines, to run for the hills, because that's not macroeconomics. So what are we looking at? What's the general tone or action of the central bank? Is that helping dollar liquidity? In this case, it's not just dollar liquidity, but we're also looking at the balance sheet, because the balance sheet unwind has also been withdrawing US dollar liquidity from the global market. We want to look at rate of change of inflation and rate of change of growth. This is a very basic macro breakdown taught to me 20 plus years ago. And there's other elements to this. This is a really general look. So let's go take a look at what Meester said. And I kind of call this the Justin Timberlake School of Monetary Policy. And I'm being kind of funny, but it's so true. Everyone remember Justin Timberlake's song, Sexy Back? I'm bringing sexy back. Well, that is what it looks like this FOMC is going to try to do by, one, keeping a larger balance sheet, and by two, possibly, although we have no confirmation of this yet, but possibly reinvesting on the shorter end of the yield curve. Now, that's how you keep a balance sheet, larger. Rather than letting it unwind, you reinvest. Rather than letting it mature and fall off, you reinvest. But where you reinvest is going to affect the yield curve. And the FOMC, in order to support the stock market, the rising stock market so far, based almost solely on the word patience uttered on January 4th, do yourself a favor, and this might be a fun exercise to do in a future recap video. Drop vertical lines on a daily chart on January 4. And then ask yourself, is this market really rallying on anything other than Powell? And if you're honest with yourself and you take a look at what that vertical line tells you, you'll realize it's a Jan 4 play, it's a Powell patience play, pretty much across the board. So the thing that could be interesting is, could that shift unravel my long bond play that's been in play since the end of November, really the middle of November. Probably not near term, but I'm going to have to keep an eye on what happens to the 10 and 30 year if they start to respond to this type of shift in monetary policy. I also want to get and stay long the XLF. This was the trade of the week for Simpler, and this was something that I explained how and when we want to start to shift to much more of a long bias on XLF after being rejected from the 26 to 26.50 area to the downside, landing within the wave, and then buying and following the trend. So again, I don't think the FOMC today said anything that was earth-shattering. They didn't do anything to shake the confidence that the market has in Powell right now. They didn't hear anything much more positive, so there's no reason to really rally the market all that much. But be aware of how this market might start to digest, keeping a bigger balance sheet, what that might mean to the yield curve, and whether or not Justin Timberlake, aka Jerome Powell, wants to bring sexy back to the yield curve. What that could do to financials, stay long. I think we can still stay long bonds across the board, but we might start looking at the shorter end of the yield curve a little bit more in the next 2 to 4 weeks. I'll see you in the next update.